Good afternoon, everybody. This is another episode of the Bizport M&A Peelback, where we discuss the most interesting M&A deals that we think potential founders might want to hear about. And today, we have a really interesting one to put on the table. This is Procter & Gamble acquiring Thorne, the supplements brand that I'm sure you know about. This was a really interesting story about how Thorne got started, how another buyer actually bought the brand after it IPO'd, and then now how we are in the next chapter of a Procter & Gamble acquisition here. So a couple of questions to get us started. What did Procter & Gamble actually buy? Was the $3.8 billion smart, or was that like top of the market? And what should a founder take away from this transaction for their own brand? So Kyle, I think probably to understand this transaction, we need to start off way back when in the 1980s to understand Thorne's founding story. You agree?
Yeah, start there. I think the company DNA is super important for this deal. So for context, so in 1984, that was when the company was founded as Thorne Research by this guy named Al Japp. I don't know if I'm butchering his name, but the company was based in Idaho. I did some research on this guy, and he's actually a scientist. He has multiple patents and really took a very science-backed approach in building these like high purity products. Another thing worth noting too is the way he sold these products was through health professionals, primarily.
Gotcha.
Especially back in the 1980s, they didn't have Amazon or anywhere else.
Right, yeah, great. So the only way to distribute a supplement, let's say, would be through a healthcare professional or maybe like GNC. I don't even know if GNC was around back then, but if it was, something like that.
Right.
Yeah.
And then they also had like some good sponsors as well. Like for example, they're NSF certified.
Yeah, true.
Working with like Olympians and professional athletes as well.
Yeah, totally makes sense. Okay, so that was the 1980s. Then take us to, kind of the more modern age. There's another big update in 2010, it looks like.
Yeah, so in 2010, this guy named Paul Jacobson, he acquired Thorne Research in 2010, and then co-founded alongside Thorne this company called Longevity, which is like a health intelligence and testing company. So the idea was to merge the two and basically become this more like health tech company, but with a supplement kind of brand.
Yeah.
I relocated the company from Idaho to South Carolina just to basically ramp up manufacturing.
Makes sense. So it was like a pure play, like almost like pharmaceuticals. Hey, we're making really high grade supplements here. It seems like, right?
Yeah. It seemed like Longevity was also, I think the intention, if I were to guess, was credibility is everything, right? With supplements, even today, where you're dealing with a very critical consumer.
Yeah, right.
Well, there's tons of similar products in the market, and they kind of need to figure out which ones are actually effective.
Yeah,
I think one would be one solution to kind of validate that point.
Agreed. And actually, to that point, what does Thorne sell today? I can give some basic guidance here. Pretty much run of the mill supplements, and we can get more into that. But I, for example, have their magnesium bisglycinate. They have a creatine product. They have a prenatal and a neonatal product for nursing mothers. These are all products that like you could basically buy at any grocery store under any brand. But there are a number of sort of like clean, good manufacturing process differentiators where the Thorne brand has been associated with clean ingredients, natural ingredients, whereas that may not be the case for your grocery store brand, vitamin D3 pill. That seems like the original angle for the founding story, right? It's like clean pharma, right?
Yeah, exactly. Yep.
Yeah, interesting. Okay, so then you mentioned they Paul Jacobson, he acquires Thorne Research, he co-founds Longevity. This is like in the early 2020s. Then Thorne goes public. So like, why does that happen? What are the mechanics around that?
Yeah, so it was kind of bad timing.
Yeah.
In 2021, they went IPO as Thorne Health Tech. So again, really leaning on that health tech kind of positioning in the market.
Yeah.
This was like late 2021. They're valued about roughly $500 million. And they also merged with another company, or I should say acquired a company called Precon Health, which is a brain health company.
Yeah.
A couple of years after that IPO.
Right.
That wasn't successful. And, I believe it was kind of just a limitation of their sales distribution strategy at the time. I'm sure COVID kind of like helped affect that as well. Again, like on the bad timing piece.
Yeah, definitely.
What do you think? Why do you think it wasn't that successful?
I don't know. I mean, I think timing's a big part of it. I also think like it was time and place, right? Like, was there a lot of focus in 2021 on health tech products, or even at this time it was like a B2B health distribution pharma company. I actually think the world's focus was on e-commerce at the time, right? Like e-commerce had like 10 years of growth in a couple months post COVID. So it wasn't exactly the time. Like I bet their IPO would have gone better if they had IPO'd a year later. But anyway, who knows? Anyway, that story doesn't go so well, right? They go public in 2021, and then in 2023 they're taken private, right? Meaning a firm called L Catterton, by the way, big consumer private equity firm based in the Northeast, decides to just buy out all the existing shares at like a 94% premium to the previous 30-day close amount. So they're basically paying 2x what the business is worth to investors, public investors. They take the business private. So that's super interesting, and that's that happened to Allbirds earlier this year. A lot of these kind of other kind of platforms, they get to the point where they're stagnant, and private investors can just buy out all the existing shares, and I think that's pretty interesting.
Yeah. And,
Right.
and I'd say on top of that too, Al Catterton installed the former CEO of Vitamin Shop,
Hmm.
Colin Watts, which is
Interesting. Did not know
I
that.
feel like he also came from Weight Watchers. He was the former president
Yeah.
there.
Yeah. Right. Right.
And I believe Walgreens too. So he's been all over kind of like the kind of pharmacy industry as well as like kind of the fitness industry as well.
Yeah. Yeah.
So I felt like that was like a, pro move, really, really following that PE playbook.
Yeah, he's
Really.
like Mr. New Year's resolution, isn't he? Something like that. So that's interesting. So maybe their play was, hey, like, can we go and scale the B2B distribution of Thorne, right? Maybe was that the initial play? That's what it seemed like, right? That could be reasonable, but then that's not what happened, right? Because so when the business was taken private, revenue was around $300 million, and the revenue mix was like 60% B2B. So like healthcare, professionals, retail, et cetera. And it seems like maybe the ceiling topped out on the B2B distribution angle, right? And then something really interesting happened that I want to toss around, which is LCAT decided to turn that on its head and acquire direct-to-consumer customers, not B2B customers. So at acquisition, there were something like 4 million, I guess, historical customers in Thorne's Rolodex. And today it's roughly 7 million, right? Like we're almost doubling the number of direct to consumer customers, and revenue has exploded as well since then. So that's pretty interesting around, hey, like B2B scaling this platform is not working. Let's go the other way.
Right.
And that's why we're talking about this deal, because it's so interesting. It's the power of direct to consumer, right? And if you can get that customer acquisition and retention piece right, that's like very, very valuable on the public market. So now that brings us to today. What did Procter & Gamble actually buy? This is like super interesting. I want to toss this around. Today, the financials that we see are the headline price here is $3.8 billion for this company. And that's crazy. We will dissect that later. That's the $1 million question. But they're sitting here, they bought a company, L Catterton bought a company that went private. Now Procter & Gamble is buying the refactored direct-to-consumer version of that company. What are a couple of the things that they're walking away with here as Procter & Gamble?
Yeah. Well, I think for one thing to note, right, like their growth has been impeccable ever since 2023. L Catterton kind of took over.
Good point.
Do you actually have the numbers in front of you, what their revenue growth
Something
looked like?
I see it was about 300 million at acquisition when LCAT bought the company, and in 2026 they were underwriting 650 million. I think 2025 full year was around 500 million of revenue. So materially up, let's call it 40% from, or no, more than that, 60% from acquisition, right?
Yeah, that's insane growth.
Yeah, that's crazy. And a lesson there is to point out, like, yeah, the business had, this struggle in the public market. It was taken private, but L Catterton turned it around and they were selling it at a super opportune moment. And I think that's a really important reason why this headline price is so big, right? And we'll come back to that. So I think that's one piece. Now, they are also buying 7 million historical customers, many of which L Catterton is responsible for. And so, like, if I'm P&G, like, why am I buying this versus going and doing it myself? Like, I don't know why would I sell at $3.8 billion?
Yeah. I think honestly, like, going back to the company's DNA, I think it's baked into the brand. Like, this was science-backed brand from the start.
Yeah.
And that has like a ton of credibility in the market where every consumer self researches like all the products before they consume them.
Yeah.
So I think that's been a big piece where they spend a lot of time, money, resources into this R&D, and like will continue doing so,
Right.
just to make sure all their products are safe for consumers and actually impactful.
Yeah. Yeah. And also, that's part of the purchase price is at least to cover the clean, good manufacturing practices that have helped build the Thorne brand as a trusted brand, right? Like we know it's not snake oil. We know it's good manufacturing process to get these like supplements out there. That's kind of brand goodwill. That's hard to put a direct price tag on. I think some very specific like tactical things that P&G is buying as well is they're buying a demographic that they don't like serve super, consistently across their house of brands. 60% of Thorne's revenue is from people who are under 40, I believe. So is that interesting? Like, do they have different purchasing patterns and different like wellness needs than somebody who's older, right? I think that's interesting. And then also, I think there's like kind of a tailwind happening here where like we've got the Make America Healthy Again campaign, we've got the GLP-1 campaign. That's like kind of in the collective conscious of consumers under the age of 40, I think today. And they might be buying some of that tailwind and the momentum there that would accrue, we assume, to Procter and Gamble's main business. Now, also to give you a sense of like how big P&G is. Kyle, I think we talked about this yesterday. I think they did 50 billion of free cash flow in 2025. Is that right?
I think might be closer to 15 billion, but still ridiculous.
Yeah. Okay, I misheard it. 15 billion. Regardless, an insane level of free cash flow. Even if they finance this all balance sheet equity, this is not that big of an acquisition for them, which is crazy because it's massive. So yeah, I guess to land the plane on that, it sounds like a big thing P&G is buying here is demographic, clean, good manufacturing processes that show up in a strong brand. And also they've got 7 million relationships that they probably couldn't go create themselves, right? Like you could try to start a D2C brand and get 7 million customers to accrue, but like how expensive is that going to be? Probably cheaper to acquire the manufacturing, the customers, and the brand reputation all together, right? Yeah, you can't manufacture that trust, I don't think, even if you're P&G. So, okay, cool. Now, valuation. Cover the numbers for us. You're the quant, Kyle, aren't you?
I'm the quant. So the price tag was $3.8 billion on a little over 500 million trailing revenue.
Yeah.
This was around 7.66x sales.
That's crazy.
Yeah, crazy. I would say, I don't know. It's a steep valuation, at least looking backwards.
Yeah.
But I feel like they're not looking, they're not only looking backwards with this valuation, they're looking at the growth rate, right, that they've sustained over the years.
Yeah, something like 30% year over year growth. And it's interesting how, L Catterton did a good job, I think, of repackaging this brand and they're consumer investors, right? So I think their underwriting criteria were probably related to, hey, we can turn this into a direct to consumer engine and enjoy the multiples expansion from doing that. And that is their DNA. So I think that was a big part of their upside. And by the way, if I'm the deal lead at L Catterton, I'm feeling very good right now. And I hope L Cat investors are also, thinking that way as well. And so, but interesting piece, if you're P&G, are you holding the bag? Are you paying up for a rare asset, or are you buying at the top of the market? Like, I don't know how to calibrate that.
Yeah, it's tough. I mean, I have some like anecdotal thoughts.
Yeah.
Where obviously COVID took a big hit on a lot of people's personal health. And I feel like the last few years have been kind of rebounding. And this is why like products like this kind of exist and are thriving. So maybe it's kind of like we're still catching the tailwind. And I think there's a lot of opportunity to like for consumers to kind of value products like at Thorne are manufacturing.
Yeah. And what has to be true though, if you're P&G and you're paying almost 8 times revenue for let's say this brand's doing 500 million of top line. Let's assume like typical D2C type margins are roughly like 20%. So maybe 100 million of EBITDA from that 500 million in 2025. So that makes the effective EBITDA multiple like even higher. What like has to be true for that to be worth it as a buyer,
Yeah. Well, growth rate for sure still needs to sustain those like double digit levels every year.
Yeah.
One thing we also didn't really touch on specifically, but I think it's important to call out is all these supplements are repeat purchases.
Really
even on Thorne's website, right? There's subscribe and save for like almost every product.
Yeah.
And I'm sure that the Thorne products you use as well, you probably replenish them every 1 to 2 months.
Absolutely. And have been, for a really long time. I bet if you're point, the subscribe and save as a percentage of total revenue is probably very high. And also the average LTV curve is probably, extremely, extremely, durable. And and we assume the churn, one of the assumptions I guess P&G has to take here is that the churn rate will be relatively low and that those 7 million customers will actually accrue over to the new platform and maybe to other P&G product lines. Like we don't know that. That's a really interesting takeaway for founders here. You see crazy, crazy revenue multiple here. Like we don't see this that much, Kyle. Like we see some revenue multiples. I don't think I've ever seen nearly 8x on revenue, right? And we were just chatting with another founder about this morning, the importance of not just repeat purchase behavior, right? Like people buying the same product twice, that's cool. But how about contractually obligated subscription revenue where your customer throws down a card and agrees to be charged every 30 days or every 60 days for, replenishment? That is gold. And I know that sounds like, every SaaS investor's pitch here, but what's hard about e-commerce is if it's a one purchase and done type product, if I can chart an LTV curve and relate that LTV curve to what it costs me to acquire a customer, that's a much easier piece of math for me to do. And also I'm more willing to underwrite that as a buyer, right? I think that's like critical. And so even let's say you have a brand out there in the market and you're thinking about how to scale it or sell it, or you're thinking about starting a brand, like always think through how can I create a product that has a natural subscription tendency, right? Because that's what buyers will pay up for if your goal is to sell that company someday.
Yeah.
So that's super interesting. Yeah. And the other thing is, I guess Thorne is a mass market brand at this point, but for a very long time, it was very premium, right? It was very much like a pharmaceutical first, very clean. They had some great influencers on their platform. I think that also probably factors into this multiple where it's not like some bottom barrel, brand that people don't know. I'm pretty sure everybody, like I don't know anyone in our demographic, let's say sub 40, who has not at least heard of Thorne, right? Like, Is that fair?
Yeah, I think it's fair. I haven't used Thorne before products.
Yeah, but you know it.
I've definitely seen them in stores multiple times.
Yeah, exactly. Okay, interesting. So valuation aggressive, but might be reasonable if those things are true, right? And I really think it comes down to growth and then subscriber conversion, right, over to the mothership. I also think it's good to think about Thorne as like, don't think about the products necessarily or just the supplements. Like this is kind of like a wellness platform that P&G can probably use to harvest information about purchase patterns, home goods, interest, whatever product interest across their other product lines. And like the data supplied by Thorne might be like very valuable to P&G's business. That might be built into the multiple too. Okay, so interesting. If you're P&G, what does success look like? And how difficult would this deal be to close if you're, let's say you're under LOI trying to close this deal and you're a buyer?
Yeah, well, I guess I feel like their sales and distribution and validating all that and receipts of revenue, I think that all would be straightforward. Also time to do.
Yeah.
I actually think the long tail might be related to the actual supplements.
Yeah.
And understanding the science behind that and efficacy.
Yeah.
Because to your point, like there's just like there's so many brands. I feel like there's new brands coming out every single week around supplements. But it's like the question is like which ones actually work and like will impact you there.
Yeah, that's right. And like it's a question of course, will they work, but also a question of like, will they not cause harm? Right. That's another piece. And actually, I have a friend who knows of this deal and is familiar with the space and was saying, if anything changes in the product quality here post acquisition, that is a real change and a real risk for P&G. Now, of course, that's because of this history from 1984 of creating like the world's cleanest supplements. And if anyone can maintain that manufacturing standard, it's probably P&G, but that is a risk, right? That's a piece. I think we also covered, real subscriber churn risk, assuming they're not too disruptive over like how people order their supplements and the product set. That's probably not a massive risk. And, the other piece is like, can you enjoy synergies from, Thorne's data set to the rest of the Procter & Gamble ecosystem? Not necessarily a risk. It's more so something that needs to be proven and is probably hard to put a number on. That's my guess. Anything you'd add?
Yeah, no, I think my guess is probably P&G will retain the brand because it's such a well-known brand in the space.
Yeah,
I think it'd be huge risk if P&G tried to do a full rebrand or something.
Yeah.
like
Yeah.
that.
Agreed. And they would be smart to do that and probably also retain some key leadership. We always talk about this. If you are a founder selling a brand really of any scale, but especially if you're on a growth trajectory, that the buyer who's buying you will probably want you to stick around to continue that trajectory for a year, 2 years. We don't know. They should make it worth your while, but like you should expect that. I think the idea of like, hey, I walk away from my brand and I never see it again at close is probably not realistic. Do we ever see that, Kyle? Like never.
Yeah, like 2% of the time, if that.
Yeah. Okay, so let's give it a scorecard. Let's give the buyer a score A through F, a grade. Let's give the seller A through F, and then let's give valuation a score A through F. I'll let you do buyer first.
Buyer. I love the play here. I think it is a very unique product offering that has a lot of credibility in the market, especially with the younger demographic as mentioned.
Yeah.
I give that an A.
Yeah.
Valuation wise, I'm not sure. Of course, the seller, it's probably an A or S tier.
Yes, I think seller gets A++, right? Because how do private equity firms think about this? Actually, this is probably useful to expose. PE firms will look for a couple of things. It's worth covering a common rule of thumb in private equity, which is known as the rule of 40. So private equity likes to buy brands where the sum of the growth rate of the business year over year and the net income margin is 40 or above, right? And I bet they're getting that with Thorne. I bet they were close. They were probably close to the lower threshold when they bought the brand. I think Procter & Gamble is for sure getting that as a buyer. So from an underwriting perspective, they probably did a pretty interesting, deal here. The other thing is private equity. If I'm L Catterton, the way I'm calibrating this deal is what's called internal rate of return, which is a function of how much upside am I making over what time horizon, right? So in this time horizon, the entry price is 680 million, right? Something like that. It's been not even 3 years, not even 36 months. And I'm exiting for 3.8 billion. Now, there's going to be leverage on this business. There's going to be a capital stack. Like that all needs to be paid out. But they are absolutely crushing it from an IRR perspective. This is useful for founders to know too, right? This is how a PE firm, if you're looking to sell to one, will probably look at a deal, right? And they want to make sure they can buy you at 680 million and exit you in 36 months at 3.8 billion. Now, is that common? No, but that's a nice benchmark.
Yeah. This investment alone probably carried the whole fund for LCAT.
Probably, right. The bonuses up in Greenwich, Connecticut are going to be pretty fat this year. Okay, interesting. And then final piece, I think on valuation, it's kind of TBD. We don't know A through F. Let's see how well these subscribers plug into the P&G mothership, and let's see how well the manufacturing synergies like really accrue to the buyer here. So interesting. Well, I think that about covers it. We're at about time here, but of course, wish the buyer and seller luck here as they move forward with this transaction. It's a pretty brilliant PE trade. There is an integration risk. We'll see how well P&G made up here. And by the way, we would love to peel back additional deals in the direct-to-consumer world. If there are additional transactions you want us to opine on, please tell us, comment. But we are happy to do our best. Thanks, everyone.